Hello there. Welcome to Be the Boss of Your Money. I'm Mitch Goldberg, your host. And this is a show about personal finance, investing tips, business. It is the place that you go to become the boss of your money because we don't want your money to be the boss of you. So we've got a few things to talk about, but today there was definitely a bit of a sea change, and it's really just one of the most important things that we've seen from the Federal Reserve in many, many, many years. Because if you are a student of economics, it feels like everything has been turned on its head today. And finally, the Fed gave up on inflation. Are they doing this at the worst possible time? Is this a contrarian indicator? Should you right now say, you know what? Now that the Fed's thrown in the towel on inflation, maybe we should plan for inflation now. We have a few things to talk about, but the bottom line, every financial projection, whether used by insurance companies, banks, planning, corporations, it's all based on expectations of interest rates and inflation. So that is the story of the day. So we're going to roll the intro real quick. Stick around. This is going to be good. It's going to be a little wonky, but it's also going to be a little quick. And I am actually happy about that because it's beautiful outside, and I know you want to get out. So if you're watching this in the replay, welcome to you as well. Anyone watching this, certainly ask your questions in the comments of this because I would love to get back to you. That's my favorite part. Here we go. Okay, we are back. Hey, everyone. I'm over here. You see, over here on the side. Hope you could see this okay in your small phone screen if you're just watching on a smartphone. I'd like to welcome you to this show. It's called Be the Boss of Your Money, and I really mean it when I say I want you to be the boss of your money, not your money to become the boss of you. It's really easy to lose control of your finances, of your money, debt, interest payments, payments for this, payments for that, expenses, unexpected expenses. So that's what this show is all about. So sometimes we get into investing, sometimes personal finance. I have guests that come on that talk about things like estate planning, insurance, all kinds of things that go with that, business development. So what we need to do is keep going, keep learning, and that's a journey that I'm on. And the best part of the journey is being on the journey with other people. That's you, by the way. So you're coming along for this journey because this journey becomes your journey and it's my journey. So we go through this together. So let's take a look. The Dow is up 160 points. The S&P was up a bit, up about 10 points. Today was the first time ever, by the way, that the S&P crossed over 3,500 earlier today. We always pay attention to the Dow. The Dow is at just about 28,500. But, we don't really, but if you ask somebody, well, where's the Dow? Oh, 28,000, 29,000. You've heard it a million times. But people don't really know where the S&P is. So the S&P 500 is about just under 3,500. And it seems to be just running through record after record every day. NASDAQ is 11,600, off about 40 points. Not a hugely steep down day for the NASDAQ. But in a day when all the other major averages are up, it does become a little bit more noteworthy to see the NASDAQ down 0.34%. The Russell 2000, that's this one right here. That's small caps, companies that are more economically sensitive. Smaller companies, they don't have the same access to credit and, selling shares and IPOs like the big companies do, and the more typically domestic oriented, not international. So, but that had a pretty good day too. The small cap stocks, the VIX, VIX had a pretty big up day. I've been saying for a while now that the VIX, the line in the sand is 25 and under. So we're right, just about up to 25. So if you see the VIX go above 25. Typically, the VIX goes down when the market goes up. You like to see the VIX go down. That's an opposite thing. But the VIX is coming up a little bit, and that's could start to get a little scary for some investors. It's known as the fear gate. So if it goes up, the fear goes up, and it just means money managers, professional investors, and traders are willing to pay more to hedge their bets, to hedge their portfolios. Okay, so let's keep going on. Let's take a look at this. We take a look at this every day. It's like getting a little sick of this, but it's part of what we do. The FANG M stock. So Facebook, Alphabet, so Facebook, Amazon, Apple, Netflix, Google, and Microsoft. The six, horsemen of the Dow. Okay. Um, it's usually like the four horsemen, but I'm calling it the six horsemen. So these are the six biggest publicly traded companies in America. But Facebook was down 10. Facebook had a huge update and broke through 300 for the first time yesterday. So to give back 3.5%, it's it was up a lot more than that yesterday. So that's okay. Apple down a little over 1%, still holding that $500 mark. Amazon down 41 after hitting a new high yesterday. Netflix off about 3%. Google, which is now called Alphabet, by the way, they kept the same stock symbol, GOOGL, so we still call it Google, down less than 1%. And the only standout here is Microsoft had a nice day, up 2.5%, up $5. But generally speaking, when 5 out of 6 of the largest companies are down, that typically will pull down the NASDAQ to an extent. Sometimes it'll pull down the S&P 500, even though the S&P 500 bucked the trend. I'll show you why. Let's take a look real quick at the reopening stocks. American Airlines, United Airlines, Delta, Carnival Cruise, Norwegian, Royal Caribbean, Planet Fitness, Cinemark Holdings, movie theater company. I call these the reopening stocks, and they were all up today. So you had another little bit of a shift. We've been seeing this lately where investors are taking a little bit of profit on the super large tech stocks in the tech sector in general and moving that into some of the more economically sensitive names, industrial stocks, work from home, reopening stocks. So the work from home, the FANG M stocks in particular, work from home, stay at home. These stocks were mostly down today. The reopening stocks were mostly up today. And the leaders of the market, this is my most important dashboard. We do this every day, but financials led the pack. That's significant. Whenever financials lead the pack, that's something you like to see. That means investors are believing that something good is happening. It's always the banks. Follow the banks. If the financials are starting to lead the way, that is generally a good sign of bullishness from investors. Okay. Real estate was up a little, healthcare, but industrials were up. Utilities. Overall, it was a good day. Technology, that's the XLK. That was barely, up 1%, barely up. Communications are off. By the way, these are the ETFs that track each of the major sectors of the economy. The XLC is Netflix, Alphabet, and Facebook. So it's like half of it is just in those stocks. So I always like to say, what's the point of having an ETF if you're going to have such a heavy weighting in just a few stocks? But that's the way it is. We don't make the rules. We don't break the rules. We just have to take the pitches as we get them. So I want to teach you how to swing for different pitches. I love these analogies I'm coming up with. And the last thing I'm going to show you before I get rid of the screen share is this. This is the most, I think, significant thing that I've read today. It's a really easy, quick read. Ron Insana is a markets commentator. He wrote this, what it means for markets now that the Fed has given up on the Phillips curve. Just go on CNBC.com and you'll find it. But it's a great article, and I'll talk to you about this. So let's get to the heart of the matter. We've got a couple of minutes left. So let's just get comfortable here. We'll get comfortable here and talk about some of the stuff, okay? So here's the thing. The Fed has been trying to goose inflation for years, since the Great Recession ended in 2009. And I'll have an article about this, but it's expected wisdom or it's dogma now that 2% inflation rate is the rate of inflation that we want in a developed economy because it keeps the economy moving. Prices are going just enough to keep the economy growing, but not going up so much that it hurts the economy and hurts consumption and sends the economy into a recession. So the Federal Reserve has been trying to manage inflation very closely, and it's been trying to goose the rate of inflation, above 2% now for like the last 10, 11 years. And the Fed has a piss poor track record in goosing inflation. So I'm going to give you a little history lesson, but it's important that you know this. In the late 70s and early 80s, yeah, I'm going back some time, but Paul Volcker was the Federal Reserve chairman. And the whole world was suffering through inflation in the 1970s, and it was hurting the global economy really badly. And it was hurting emerging markets, developed markets, and it was just economic stagnation. So what Paul Volcker did is he jacked up in interest rates to like 12, 13, 14%, crushed the economy. But what happened is he squelched demand so much that prices went down. And once prices went down, we haven't had a problem with inflation since like 1981, 82. And the low inflation helped usher in a time of massive productivity gains in the 80s and 90s. And the productivity gains haven't been that great, since the early 2000s. But productivity has remained pretty steady, even at a low rate, and inflation at a low rate. So people think that steady inflation creates steady productivity gains, and we have productivity gains, we do better as a society, better economically, more people get to participate in the economy. I think there's something backwards, though, because what also happened in the early 80s when Volcker was jacking up interest rates, we had the advent of the PC, the personal computer. I'm of the mindset that inflation would have come down anyway because once, businesses started using personal computers, efficiency, productivity started to skyrocket. And that continued throughout the 80s because of technology. People from administrative to executives to manufacturing, everybody around the world, corporations around the world were able to do more and more because of technology, because of the computer. What happened in the 90s is we went from having a workstation, a computer on our desk, to connected computers, the internet. So productivity continued to skyrocket throughout the 1990s. And it slowed down in the 2000s. We had the tech wreck. We had a mild recession in 2000. We had 9/11, but that really I don't think slowed it down. But the point is, we've had lower and lower and lower inflation over the last 40 years, 1980 to 2020, 40 years, because of technology, because of globalization, because we've been able to shift manufacturing to areas with lower labor costs, lower energy costs, and that is, lower regulatory burdens, and that has enabled the prices of everything to come down. Plus, we've had much more better capacity in mining. So anything that you could mine, from aluminum to iron ore, we've just been able to get tons and tons of this stuff out of the earth because humans have gotten so efficient at mining. And so we've just had a glut of everything mined and man-made, and technology's hasted this, has caused this. And then you have so Anyway, the point is, I don't think the Fed has had as much to do with economic cycles as people like to think. I do think the Fed has had a lot to do with the prices of assets like stocks and houses, because those are interest rate sensitive sectors. But when you have low interest rates, you were able to increase the future value in your future value calculations of literally all asset prices. So fast forward to now, we had low unemployment right before the pandemic hit, like 3.5% unemployment rate. And it used to be that the Federal Reserve would worry that once unemployment went down to, it used to be that the Federal Reserve thought that if unemployment hit 5% or lower, it would automatically spark inflation. So when unemployment got real low, the Fed would just be preemptive of inflation and raise rates. Our current Fed chairman, Jerome Powell, tried this in late 2018, and it kind of turned out to be the wrong decision. It was a little bit of a headache for the economy. It wasn't a disaster, and he did reverse course on those interest rate hikes because he thought inflation would come around. But it doesn't, and there's something that's changed. Low unemployment stopped sparking inflation, and the Phillips curve is something that measured inflation. A British economist whose last name is Phillips came up with the notion that from like the 1850s to like the 1950s, whenever unemployment would go low, that the inflation that wage push inflation would have to rise. But the Fed has basically given up on the Phillips curve, and it's now said, whatever this connection we thought between unemployment and inflation, the connection is broken. It's either broken or it never really was as strong as we had thought. So the Fed has always said that we have a dual mandate, which, believe it or not, came around during I think it came around during the Carter years. Okay, the Fed has a dual mandate to maintain low unemployment without sparking inflation. So it's a dual mandate. But what the Fed has come out today, the Federal Reserve has come out today and said, we are going to not just let inflation keep running higher, but we're going to look at wages also, at unemployment and wage push inflation. That means wages going up, so wage inflation. But we're going to look at it at the bottom rung of the socioeconomic labor pool of the U.S. economy. So what that means is, instead of having, and this is something that the Fed has looked at, is the wealth gap, the difference between the haves and the have-nots in this country is wider than ever. And what the Fed has been viewed as the market's pawn, whereas if you own paper assets, you keep getting richer, and if you're struggling to get by and you can never afford to invest anything, then you're just getting further and further behind in the wealth accumulation game there. So the Fed said they're going to go by the lower rung of the socioeconomic group. They're going to keep rates lower for longer, and they are going to allow inflation to get above their 2% inflation target, because they want to see the lower rung of the socioeconomic labor pool do even better. And they don't want to just keep goosing up the market and letting the top get richer and the rest of the country get poorer. That's the wealth gap. So in a way, I wrote this down here. I wrote, the Fed has become, it's like the Federal Reserve is going from Wall Street's Federal Reserve to the common man's Federal Reserve to help with wealth inequality. So there are a lot of reasons why inflation has gone down consistently, but basically, inflation has been going down ever since the advent of the personal computer. And you could give all the credit you want to the Federal Reserve over the years, and I think the Federal Reserve has an important part to play. I'm not anti-Fed. I'm not one of these people who says, oh, you should abolish the Fed or go back to the gold standard. No. I'm not going there. The Fed serves a lot of purposes: market regulation, the overall economy's cop on the beat, and they do a lot of other good things too. and they provide liquidity to the market, like when you have a pandemic, when we need it most to keep the economy functioning. But what the Fed has done now is they say they're going to let inflation keep going. If you want to bet that inflation will come around now because of the Fed's use of Fed policy and they're going to not raise rates, this is why the bank stocks rallied today, because the yield curve, the difference between long-term rates going up compared to short-term rates has changed, has gone steeper. Long-term yields are not as anchored to short-term rates as much, since today, which you'll probably start to see mortgage rates go higher. I'm not saying they're going to be explosively higher, but they're definitely going to get off the rock bottom lows that they are now to a higher rock bottom level. So that's what changed. So this is really a big signal that the Fed is going to let interest rates climb, let inflation expectations climb. This should be good for bank stocks. Probably should be good for precious metals. So that's what I'm going with, and I just wanted to share this with you. Okay, so kind of wonky today, but I thought it was significant enough to share with those who are interested in how these things work. I know I find this stuff fascinating, and I do know a lot about this stuff. So if you have any questions about this, hit me in the comments, reach out to me, send me a DM. If you have any ideas or topics that you want me to cover, let me know, and I will see you soon. And I want to wish everybody a fun-filled, happy weekend coming up. Thank you.